Welcome to a video that I like to call the deep dive video, and I explain this every week. Please don't take this out of context. I use it in a little bit different way. Every week I do a number of videos. I do a video each day. I do a weekly video. Also once a week I do an intermarket analysis video. What I do for the last video of the week is I go through all of the daily charts and I pick out those charts that maybe I didn't talk about at all, or maybe just one or two times, that might be saying something that we were missing that I didn't include in the daily videos. Sometimes we can pick up some little clues because I try to just go through and show those charts that are actually telling us something, but you never know what additional insight we might get. There are also some additional charts that I show in this video that I don't show in any other videos, so you still might find this useful. This is being prepared for Monday, November 13th. The first chart is only for this video. And what I have on here is the VIX, but that has been turned invisible. Then on top of the VIX, I have a 50-period exponential moving average. And this tells us how the range is going over a period of time, because we tend to use the VIX with static numbers, 12 to the downside, meaning there's no fear, 20 to the upside, meaning there's lots of fear. Well, you can see that the VIX itself, even on an average basis, doesn't always stick to that nice, neat little range. And sometimes it goes to a higher range, sometimes a lower range, sometimes a little bit higher. Over here on the right, we're wondering, are we starting to switch into a lower environment? This is something that we don't use to make decisions. It's just more informational about what's happening in the market. Another indicator that we use that is really only telling us something, that's when I show it in the daily videos, because we do a lot of fear and greed studies. We try to guess the sentiment of the market. And then when it gets extreme, either positive or negative, we use that as a contrary indicator. Sometimes the VIX helps us, and right now the VIX has been helping us, but other times the VIX may not be telling us all that much. So we use the VIX in a little bit different way. In the middle, this is a VIX to the S&P 500 correlation. And when this gets really high and spikes up, a lot of times that will mean that the market is getting ready to move. Usually it means that we're at a bottom, because that means the VIX is outperforming the S&P. But sometimes it just means that we might shift. Other times it might just mean a pause. However, right now, it's not really telling us anything because we're not up to this high level, so I haven't been using it. Then we look at how fast is the VIX moving, and we use this with an RSI based on 9 periods. When we're really going down, that means the VIX goes up. In fact, in the early part of September, actually latter part of September, we started to get an extreme positive reading when stocks were really going down. Right now, we got close as the market was really going up, but we didn't get to an extreme negative reading as the market had been really advancing. We're just coming off of that right now, so it's not really giving us any additional insight. Then we look at another kind of form of the VIX. This is called the skew index, where the VIX is created by using at-the-money options. Well, the skew index looks at out-of-the-money options. And when we get up into this red area, the market is anticipating some kind of a big move. Now, you can look at other times when we spiked and came down. Sometimes that marked a top, sometimes a bottom, sometimes a continuation. So we don't really know what's going to happen. Right now, we're just about at the midpoint and we're not extreme, so I haven't been using this chart. Then I have been showing this chart, but in a shorter version. This is a 5-period simple moving average of the equity put call ratio. This measures how many puts are being called, or puts are being purchased when compared to calls, okay? And people use puts to hedge. I teach that in my program, that you should always hedge your positions in case you're wrong and you want to lock in some profits or protect your capital. Well, the market does that as well. And when the put call ratio goes up, that means more people are buying puts. And when this gets to a really high reading, we take notice of that. Now, the market's been going up. Well, it was comatose for Monday, Tuesday, and Wednesday. It went down on Thursday, then up on Friday. But the previous week was one of the strongest weeks we've seen in a long time. But right before the weekend, what we've been noticing is the equity put call ratio has really been spiking up. And that would make sense because we've got a lot of geopolitical things going on right now, specifically in Israel. And folks can't get in or out of the market over the weekend. So what they do is they may load up on puts to protect their long positions. And we might see this really drop after Monday's session because people are taking off some of those hedges. So this is giving us kind of an extreme reading. And we're watching this in a shorter version of the chart because when we tend to spike up and then start to come back down, that can quite often mark a bottom in the market. We also look at the MOVE index, which measures the volatility of bonds, and the VIX in the middle, that measures the volatility of stocks. And then the green line down here is just the difference between the two. I take the VIX and subtract the MOVE index. But what I pay attention to the most is the correlation down on the bottom. Are the MOVE index, or is the MOVE index and VIX moving in the same direction, or are they going in opposite directions? Right now, they're having a tendency to go in the same direction. So if stocks are under pressure, bonds based on price are also under pressure, and the reverse of that is also true. We also want to keep an eye on where are we from the all-time high. We set that in early January 2022. The red line goes all the way over to the right-hand side. That was Friday's close. And right now we are down 8.37% from the all-time high. Then we keep an eye on a lot of different advanced decline lines. This one is an NYSE common stock advanced decline line. There are a lot of things that are measured in the NYSE index. This just looks at the common stock, which is what most investors end up using. Like if you buy Microsoft or Google or Apple, you're buying common stock at that point. And we want to keep an eye on what are things doing with the advanced decline line based on price, and what are they doing based on volume. We're not really seeing anything all that crazy right now, so I haven't been showing this chart. Then we have a thing called technical alerts. These are put out by stockcharts.com, and they're automatically triggered, the ones that I look at. You can set up your own. It can text you. It can send you an email and so forth. I don't use it like that. I mainly follow the indexes, the sectors, and a lot of different markets. And I've been pleased enough with those alerts that are already set up for us. But looking at this next slide, this is for the whole week. We didn't have an awful lot of triggers or alerts that were triggered because for Monday, Tuesday, and Wednesday, the market was pretty much comatose. When they are blue or green, that means they're positive. When they're red, that means they're negative. And we read this from the bottom up. This is the first trigger on the bottom is what triggered last Monday. On the top, this is the last trigger that was initiated in Friday's session, and we had a really powerful up day, so we saw lots of blue or green here. Thursday, we had a down day, so we saw some red, and this kind of gives us an indication in more of a big picture sense, what's the market doing outside of the S&P 500, and sometimes we can find that useful. Then we look at 5 different indexes. Now, everything that I focus on and all the strategies that I teach are around the S&P 500. But we also look at other indexes. So we not only look at the S&P, we look at the QQQs, which is the NASDAQ 100. We look at the Dow, which are the 30 big blue chip companies. We look at the mid caps and the small caps. And then Stock Charts has the capability of rating these in an unemotional way on a scale of 0 to 100. The higher the score, the better looking the chart. And coming in first place again are the QQQs, which is the NASDAQ 100. And this is a pretty high score at 97.5 out of 100. So it's been showing a lot of improvement. In second place is the S&P 500 as represented by the SPY. That's the ETF. We also call it the spiders. It's coming in at 87.9. Then in third place is the diamonds, or are the diamonds? Not sure. DIA. And that is the Dow. That's the ETF that follows the Dow Jones Industrial Average. And it's coming in at 74.2. Then in fourth place are the mid caps, and they've been under a lot of pressure, even though they bounced back up a little bit later in the week. They're being scored right now at 32.8. And then in last place is the IWM, which is the Russell 2000 small cap ETF. And they're really under a lot of pressure. They're coming in at 14. Then we look at some short-term charts. The first one is the short-term rainbow. And I didn't show this in last week's deep dive video because I've been using it in the daily video. But as we've been bouncing back up, we're starting to break out of the upper side of this rainbow. This goes from 10 periods up to 50 periods. And the longer we can stay above this, the more these lines are likely to turn and go back up. We also keep an eye on a bunch of different moving averages. We have a short term, which is 20, intermediate term 50, and long term 200. And if this is above 50 and going up, that's positive. If it's below 50 and going down, that's negative. We're showing some improvement across the board right here, but we can also use these like oscillators. When we get to an extreme positive or negative reading, we're not showing that right now, so I haven't been showing this chart. Then we look at a double and triple exponential moving average. These are calculated in a different way than regular moving averages, and we plot them here. The green line is the double, and the blue line is the triple. And I don't show this all that much, but it is looking more positive because both the green line and the blue line are going up. The green line is crossed back above the blue line since it moves a little faster, and price is above all of these. So we are showing some real improvement in the short term. Then some intermediate term charts. Here's another rainbow going from 50 periods up to 100 periods. We're just peeking our head out of the top of this rainbow. Again, the longer we can stay up here, the better the rainbow will start to look. We also keep an eye on Bollinger Bands. They can be very helpful, and they're also very popular. What I follow the most is a thing called the percent B indicator. When we're really moving to the upside or downside and we actually close above or below one of the Bollinger Bands, that's what the percent B indicator is measuring. And we're not getting an extreme reading right now, so I haven't been showing that. But we are leaning more positive because in the Bollinger Bands is the midpoint. And when we're above the midpoint, we're more positive. Below the midpoint is more negative. And this indicator measures that. And so we are looking more positive, but I haven't been showing this chart. I usually only break it out when we get to an extreme positive or negative reading. Then we have the anchored moving average going back to the all-time high. Now, a few weeks ago, I was really locking into this chart because we were coming down and testing this level. Since that time, we've been able to bounce up off of that. And the further we get away from this, I stop showing this chart until we start to come back down again, if that ends up happening. Then we look at the Sean trend meter. This is a proprietary indicator. It kind of gives us an idea what is the general trend of the S&P. We're in the neutral area right now with this kind of light, sickly yellow kind of color. When we get up into the green areas and as we go higher, that might be used as an oscillator to give us an extreme positive or negative reading. We did get a negative reading down here when we broke down into the pink area. And that was about where we bottomed with the market. So sometimes this can be useful. Right now, it's really not telling us all that much. Then we have the Connors RSI, which is based around the same principle as a regular RSI. This is an oscillator. So if it's above the midpoint and advancing, that's positive. And that's what's happening right now. It also works within a scale. So we can get an extreme positive or negative reading. We did get an extreme positive reading back in October. But since that time, we haven't been getting any really extreme readings. This moves around quite a bit, but we don't get extreme positive or negative readings all that often. Then we look at a double and triple 50-period exponential moving average, and this is showing some improvement too. We're above both of the moving averages. It would turn more positive if the red line was able to come up and cross above the blue line, and it has not done that yet. Then we'd have a 50-period moving average study. Since we've been able to break above this, I stopped showing this in the daily video. We're above both the simple and exponential moving average. The longer we can spend above this, the more positive it will look. Also, if the blue line crosses above the red line, that will turn things more positive because the exponential moving average moves quicker than the simple moving average. Then I was showing this for a while as we were coming down and dropping below the 200-day simple moving average. But now that we're kind of breaking back above that, I haven't been showing this chart. And then this just kind of gives us an idea. We had a high back in July 31st, and then we've been having trouble ever since then. And then we came down and we actually, based on my intraday analysis and measurement of this, we were down a little bit over 11%. I know the financial media was saying 10%, 10%. I think they were going from the close down to whatever the intraday was. And when we got to that 10% level, that's when a lot of money started to come in and really turn the market back around. And since then, we've been bouncing back up. So I have seen no need to show this chart any longer. And here's another Bollinger Band. Isn't that nice? Okay. Then we also look at a 50-day cycle. Now, I don't know if this is all that helpful or not. Sometimes it is, sometimes it isn't. There are all different kinds of cycles, and somebody can pick out their favorite. What I've found over the last year or so, the 50-day cycle has been kind of helpful. And if you look at the lines here, that's when the 50-day cycle changed. Sometimes that marked the top, sometimes it marked the bottom, sometimes the market just ignored it and kept doing what it was already doing. And we hit a new cycle on October 17th, and then we've been going down. We did hit some kind of a bottom, and we'll start to go up. Is this going to continue into the next cycle? Just mainly for informational purposes, I don't use this to make decisions. Then we want to keep an eye on the S&P 100, which are the biggest stocks in the S&P 500, just to see if they're performing about the same, and right now they are, so I haven't been showing this. Then we look at discretionary, which is more growth areas. And then we compare that with staples, which is more value and defensive areas. Well, when we look at an equal weight ETF, which means all of the stocks in here are treated the same, we're in a downtrend with discretionary. We're also in a more of a downtrend with staples. But when we do a ratio between the two, discretionary is kind of outperforming staples. They're both under pressure. And staples was one of the stronger areas, has been in 2023. But ever since we hit the skids kind of in summer, discretionary has really been taking a beating, and it's really been going down. We want to see this really start to turn and go back up, and then see this ratio go back up for things to turn more positive, and it just really hasn't done that yet. Some long-term charts. Here's a long-term rainbow going from 50 periods up to 250 periods. We're again coming out of all of the different lines here, and the longer we can stay above this, the more these lines will start to turn back up. Then we have a moving average study. I keep a 50-period moving average on top here. That's just for reference. What I'm really looking at is the 150 and 200. And we can get extreme negative here, so we can use this like an oscillator. There are also times when it can become extreme positive. But I also watch the midpoint. When we're below 250, that means we're more negative. If we can cross back above 250, that would be longer term positive. And even though we are improving, we're not crossing above that level yet. Then I mention this in every daily video, but we get so few signals from this chart. I don't show it in every video. We had a signal in early 2022, and that's just about the time the market really ran into trouble. And then we tried to cross over in April. That really wasn't happening. Then we did cross over in June. Now we're starting to cross back over negative. And right now we are negative, even though we're showing some improvement here. And I won't really show this chart again unless we see some more improvement and start to cross back above the red line. Then we look at a weekly chart of the S&P on top, and then we have a weekly chart of the German DAX, and then we look at the correlation between the two. So sometimes Europe tends to precede what happens in the US, like with fashion and even some areas of technology. They started text messaging years before we even knew what it was about. But sometimes they can lead economically and even a little bit with the stock market, even though the US market likes to think that it thinks for itself, and it does for the most part. But we want to see here now that there's a pretty strong correlation between, on a weekly chart, between the DAX and the S&P 500. Then we look at the 10-year yield in the US and we subtract the German 10-year yield, and we're coming down a little bit here. But what's amazing about this is that we can compare this to the US dollar index, which also has been under a little bit of pressure. And believe it or not, there's a strong correlation between the two. So this can sometimes give us a heads up. Now, if this is going up, that would tend to be more negative for stocks because you have the US 10-year yield going up and probably the German yield going up as well. So that would give us a positive line up here. And then if the dollar is going up too, because it's getting more expensive to borrow dollars, that could put some pressure on stocks. But we like the idea that there's a correlation, but we also might like the idea that this could be starting to roll over and actually head down. Then we have some different support and resistance levels. And when we were going lower, I was using all of these charts. But now that we bounced back up, I've taken a lot of them out of the videos. This is not really a support or resistance. This is the mass index, and this tries to measure a reversal. So if this is triggering a signal and the market's going in one direction, and then we drop down below this red dashed line, that is a signal. Well, we got kind of a bad signal back in August. We didn't get quite a full signal here in October, and that ended up being a pretty good signal. It just about marked the bottom here and would have set us up really well, but I didn't really count this because we didn't get a full-fledged signal. Then this is a trend line, and I talk about this in every video. I say the upper trend line, we're still above the upper trend line on the long-term chart. What I did here is I drew a trend line from the June 2022 low to the October 2022 low, okay? And that produces a trend line here. Then I went to the all-time high, and I drew a parallel line to this trend line down here. And this seemed to be significant last spring when we were coming back up to this level, and we hit this a couple of times and came back down. We hit it, came back down. Well, eventually we broke through that. And so I haven't been showing this chart because we've been going higher. Well, as we were coming down here, I started to break out this chart and show it just in case we were going to continue to fall, but we didn't get down to that level. And now that we're going back up, I stopped showing this chart. Then these are quadrant lines. And all I did is I measured from the COVID low to the all-time high. And then this is just 25% of the move higher. And believe it or not, sometimes for a while, this acted as overhead resistance. When we were coming down, sometimes this can actually act as support. It was kind of a red flag when we dropped below this, and then it was kind of turning more positive when we were able to get back above this level. And these red areas in here are just different resistance levels. Then this is a Fibonacci level. And what's interesting about this is this blue and green line. These are two different Fibonacci levels right on top of each other. And we were coming down and breaking below this. And I'm like, okay, maybe we're going to come all the way down to this next Fibonacci level. We didn't make it down to that level before we turned back around. We were able to recapture this level, and we've been going higher. And since we continue to go up, I stopped showing this chart. And this is an indicator that I developed decades ago for an actual trading strategy that I used. And it's a 20-period simple moving average of the open, high, low, and close. And then it just plots the lines on here. And it gives us a little mini rainbow. But believe it or not, when we're going up and then we fall back, sometimes one of these lines may act as support. When we're going down and then we start to bounce back up, one of these lines may end up acting as resistance. Other times you can see here, they didn't really care. Well, we're turning more positive with this chart because we're above the little mini rainbow, and these lines ever so slowly are starting to turn and go back up. So this is looking better. Then we have the Fibonacci levels for the NASDAQ 100. We're above the 61.8% retracement level, and we have some resistance that we were able to close above here. I'm not going to show this chart unless we start to threaten a full 100% retracement or if we start to fall back down. Then the financial sector, it's been under a lot of pressure in 2023, but so far this support level is held. We went back to the high in 2007, and then we had the great financial crisis. It took us years to get back up here. And what's interesting, when we hit this high, that was right at the start of the COVID plunge. Isn't that interesting? And then we fell down. And then with all the liquidity that was added to the market, we were able to break through this level. What was once resistance now becomes support. We've come down, fallen a little bit below this, but for the most part, this support level is held. We came down and started to test this, but now we've been bouncing back up. If we start to come back down, then I'll start to show this chart again. Some broad market measurements. This is the Vixen, where we look at the VIX for the S&P. This is the VIX for the NASDAQ 100. I don't use the bar chart here because it looks like icicles falling off a roof here. I just follow the line chart, and I don't really use this all that much. I tend to focus more on the VIX. And then we have a weekly chart of the QQQs, which is the NASDAQ 100, and an anchored moving average going back to the all-time high. Even when we were declining, we were still well above this level, so I didn't show this chart. Here's the bank ETF, which really took a dump back in March, and we've been chopping more or less sideways. When we did spring up last week, we did get up to the 200-day moving average, but then we've been falling back down to the 50-period moving average. And then we look at a ratio between the regional banks and the financial sector, and it's showing how the regional banks are really underperforming. And the financial sector isn't doing all that great. At least support is holding there, but the regional banks are doing even worse. Then we look at a ratio between the QQQs and the diamonds, or the Dow Jones Industrial Average. And I mainly look at this on the bottom, where they're having a pretty strong tendency to go in the same direction. Then here is a 1 to 3 year Treasury bond ETF. So it's based on price, and it compares it with a further out bond based on price. And when this is going up, this means that the Fed is raising interest rates. Well, ta-da! Well, earlier in the year, it looked like maybe the Fed was going to be done, and we were starting to show this ratio going down. Then in June, it started to go back up. So this is just suggesting that for right now, anyway, the market is still unsure about interest rates. Then some rate of change charts. These are pretty much only shown in this video. These are long term, 250 periods, where we've actually been declining here on this first chart, actually declining a little bit on this other chart. This looks at the close on Friday and then goes back 250 periods ago and then just measures what's the difference. Looking at bonds, where we compare the 3 to 7 year bond based on price with the S&P 500. When this is going down, that means bonds are underperforming. The reverse of that is that stocks are outperforming, and that's what we're seeing right now. Then we look at the S&P 500, which is in red, and then the long-term bond ETF, which is in blue, and we look at the relationship between them. When this is really pegged near the top, that means our long-term relationship is pretty strong. Then we look at a 10-period correlation to see how their short-term relationship is, and that's also pretty strong right now. This is more just informational, just to let us know how our stocks and bonds interacting with each other. Then we have the spread down below, I don't use that as much. I mainly look at the correlations. Then we look at a value to growth ratio, which is in black, which has been kind of turning and going back up. And then we look at the 10-year yield, which has been coming down. And I'm having a little difficulty with this, and I pointed this out a week ago. This is suggesting that they're having a tendency to go in the same direction. It's like, no, they're not. This is going down and this has been going up, and you're telling me they're going in the same basic direction? I don't think so. So it doesn't mean these indicators are flawless. Then here's another relationship between the Qs and the long-term bond. They're having a fairly strong in the same direction type of relationship. And then we keep an eye on the yield curve, and it's been going in and out, especially with the 10 to the 5. The important ones are the 10 to the 2-year and the 10 to the 3-month. And those have been improving, but they're still inverted. The 30 to the 5-year is gone back to being normal. And then the 10 to the 5 had gone back to being normal and has now dropped back to being inverted. This is what we use as a countdown to see if we're going to go into a recession. And the most important ones are the top two, the 10 to the 2-year and the 10 to the 3-month. Then I have a thing called possible positive scenarios. When we're really ripping to the downside, there's a number of things that can happen in technical analysis that can give us clues that maybe the market is starting to bottom. And I use these charts not only when we're going down, but I can also use them when we're going up to give us an idea of the health of the overall market. Well, we look at the percent of stocks in the S&P 500 that are above their 200-day simple moving average. And we are below 50. That's kind of the line in the sand here. If we can get above 50, that would turn things more positive. Then we also look at the S&P 500 on top and then the 2-year yield. Sometimes when this spikes up and starts to come down like it's doing right now, that can often give good support to the S&P. Now, if we start to fall a little bit further with this chart, I'm probably going to start showing this in the daily video in case it gives some support for stock prices to go higher. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos. This video is not meant to be a standalone video. It's just kind of a catch-all video that I do at the end of the other videos. I hope you have a wonderful weekend, and I will talk to you in the next video.